Hello traders, Gary Wagner here. It is 1 o'clock in Honolulu, 6 o'clock in New York on Friday. Happy Aloha Friday, as we say on the islands. It is the 26th day of January 2024, and this is the Weekend Review. This was a week full of both economic as well as geopolitical action, continued strikes in the Red Sea against multiple targets, both merchant ships as well as U.S. military ships. GDP report for fourth quarter came out yesterday, followed by today's PCE. The PCE showed a reduction in inflation. The fact of the matter is inflation is cooling. That being said, we had very tepid action in gold, with net changes on the close currently of down 50 cents. We've seen it trade over the last couple of hours between up $1 and down $1. Market participants are waiting for the Federal Reserve FOMC meeting next week to glean more information as to the timing of the first rate cuts. Currently, we have February gold at $2,017.30. With only a few trading days left in January, I wanted to take a longer look at what we've seen this year. Over the last 4 trading weeks, we can see a methodical decline, with 3 of those 4 weeks resulting in lower closes when compared to the open. The only week that is an exception to this rule is the week beginning on Monday, the 8th of January. It is a doji in which the net change was neutral. However, gold did trade with a lower low and a lower high during this particular week. That was followed by a strong decline of over $22 and this week's decline of approximately $12. Clearly, the action from the October rally has subsided, and traders are now in a wait-and-see mode as they get ready to hear what the Fed says next Wednesday when they conclude the first FOMC meeting of the year. By converting our weekly candlestick chart to a Heikin-Ashi chart, we can attempt to determine the strength of this current downtrend. It began with a key pivot, a green to a doji. We like that in terms of being a strong indicator of a reversal, but that was followed by the weekly Heikin-Ashis having small bodies for the next 3 weeks, with the first 2 weeks having upper wicks. The reason that upper wicks are important in a Heikin-Ashi in a downtrend is because of how the Heikin-Ashi candle is created. Rather than using the real open, they derive the open from the midpoint of the prior candle. In a downtrend, when there is no upper wick, such as here and here, it means that at no point during the trading session did prices go to or exceed the midpoint, which is why when interpreting this type of chart, the bigger the body, the stronger the trend, and that needs to be accompanied by no lower wick during an uptrend and no upper wick during a downtrend. When we look at our daily chart of gold futures, this is the continuous contract, now representing the February contract month. You can see a bias to the downside over this week, but very small bodied candles. When we convert the candlestick chart to a daily Heikin-Ashi, we're seeing the same picture. We're getting very, very small body sizes, no clear-cut strength in the trend, not like we saw at the beginning of the trend at the end of December. Again, on a daily chart, you can see that when we have strong rallies, you get large body sizes and the absence of lower wicks. The same is true during a correction. It will have a pivot, meaning the point in which it goes from green to red, signaling a key reversal. Small body sizes during the beginning. As the downtrend strengthens, the body sizes grow until you get that pivot candle. In the case of what we saw occur in October, just prior to the beginning of the October rally, was a doji-like small red-bodied candle that was followed by a strong-bodied green candle, signaling that reversal. Although technical studies can give us a rough indication of various support and resistance levels, next week will be fueled by what statements and information comes out of the Federal Reserve. While it's almost a certainty that the Federal Reserve will not cut rates or announce that at next week's meeting, what traders and investors are looking for is some clarity in terms of the timing of the first rate cut, which is anticipated to be somewhere around the second quarter of this year, from May to June. We'll get more clarity hopefully next week. The dollar did decline fractionally today with a net change of 0.01%, in essence unchanged, taking the index to 103.503. On a weekly basis, we can see that the dollar had fractional gains. Silver gave up 5.5 cents today. That's a percent decline of 0.24%, taking the most active March contract to $22.87. Our silver traders are long from a trade alert we issued earlier this week. It began with this piercing line that occurred on Tuesday, but we needed to wait for our confirming candle. When the market resumed in Australia on Tuesday, we saw an uptick. We went ahead and issued the trade alert. Our traders got in at $22.79. Our initial stop is just under this candle at $22.14.5, but we will look to move it up early next week, and I'm anticipating being able to move it to about $22.70, just below our entry price. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.